On January 15th, 2026, Brian Moynihan, the CEO of Bank of America, made a statement at a private banking conference that should have dominated every headline across America. He told a room full of institutional investors that $6 trillion could leave the United States banking system within the next 36 months. $6 trillion. That's not a projection. That's not a worst-case scenario. That's his baseline estimate. $6 trillion represents roughly 30% of all commercial bank deposits in America. Gone. Not to other banks, not to foreign institutions, to something that didn't exist as a serious threat 5 years ago. Stablecoins. And the reason Moynihan is panicking, the reason every major bank CEO is quietly restructuring their deposit strategies, is because of what happened exactly 2 years earlier, January 10th, 2024. The Securities and Exchange Commission approved 11 spot Bitcoin exchange-traded funds, and the largest of those funds, BlackRock's iShares Bitcoin Trust, just crossed $70 billion in assets. $70 billion in 2 years. That's the fastest growth to that scale in ETF history. Faster than the SPDR Gold Trust, faster than any equity fund, faster than anything Wall Street has ever witnessed. But the $70 billion isn't the narrative. The $70 billion is the proof of concept. Because what BlackRock demonstrated is that institutional currency, the pension funds and endowments and wealth managers who command tens of trillions in assets, they desire crypto exposure. And once they possess that exposure, once they perceive how the infrastructure functions, once they comprehend that digital assets can deliver yields and liquidity and efficiency that traditional banking can't match, the next question becomes evident. Why maintain $6 trillion sitting in bank accounts earning 0.1% interest when you can hold stablecoins backed by treasury bonds earning 4 to 5%? The answer is, you don't. And that's the $6 trillion exodus that's about to reshape American finance. This isn't theory. This isn't speculation. This is mathematical inevitability, and it's occurring right now while most people aren't paying attention. Let me transport you back to January 10th, 2024, the day everything transformed for institutional crypto adoption. The Securities and Exchange Commission had been combating Bitcoin ETF applications for over a decade. Multiple rejections, endless delays. The Winklevoss twins attempted in 2013, rejected. Cameron and Tyler attempted again in 2017, rejected. Van Eck attempted in 2018, rejected. The official reason was always investor protection. The genuine reason was regulatory resistance to legitimizing an asset class that threatened traditional finance. But in June 2023, BlackRock filed an application. And BlackRock doesn't file applications it expects to lose. BlackRock is the largest asset manager in the world, $10 trillion under management. More assets than the gross domestic product of every country except the United States and China. When BlackRock files, regulators listen. When BlackRock desires something, BlackRock typically obtains it. The application was different from previous attempts. It possessed robust custody solutions through Coinbase. It possessed surveillance sharing agreements with regulators. It possessed institutional-grade risk management protocols. And most significantly, it possessed BlackRock's reputation behind it, and Larry Fink's reputation, a man who constructed the most powerful asset management company in history. On January 10th, 2024, the SEC approved 11 spot Bitcoin ETFs simultaneously. Fidelity, Invesco, Franklin Templeton, Van Eck, Bitwise Invest, all obtained approval. But everyone understood the one that mattered was BlackRock's iShares Bitcoin Trust, ticker symbol IBIT. The first day of trading, IBIT processed $627 million in volume. One day. That's more than most ETFs perceive in an entire month. By the end of the first week, it had crossed $1 billion in assets. By the end of the first month, $10 billion. By the end of the first year, $55 billion. The growth curve was exponential. As of January 22nd, 2026, IBIT holds $70 billion in Bitcoin. That makes it the 19th largest ETF in the United States by assets, ahead of funds that have existed for 20 years. Ahead of sector funds, international funds, bond funds. A 2-year-old Bitcoin fund is in the top 20 out of thousands of ETFs. But the assets under management don't inform the full narrative. Examine who's purchasing. Examine the actual investor base. According to public filings with the Securities and Exchange Commission, over 700 institutional investors now hold IBIT. State pension funds, university endowments, insurance companies, wealth management firms, corporate treasury departments. These aren't retail speculators purchasing through Robinhood. These are fiduciaries managing other people's retirement currency, and they're allocating to Bitcoin through BlackRock's fund. Wisconsin's state pension fund holds $29 million in IBIT. Michigan's state pension, $95 million. The Arizona Public Safety Personnel Retirement System, $19 million. The state of Utah retirement systems hold positions. These are conservative institutions with strict fiduciary mandates, and they're positioning police officer pensions and teacher retirement funds into Bitcoin. Why? because the asset allocation models transformed fundamentally after 15 years of zero interest rate policy. For decades, the standard portfolio was 60% stocks, 40% bonds. That functioned when bonds paid 6 to 8% annually. Bonds provided income and stability. They balanced equity volatility. The 60-40 portfolio was the foundation of modern portfolio theory. But after 15 years of near zero interest rates following the 2008 financial crisis, bonds barely outpaced inflation. A 10-year Treasury bond yielding 2% when inflation is running at 3% means you're losing purchasing power. The 60-40 portfolio became obsolete. It didn't function anymore. So institutional investors initiated examining alternatives. Real estate? But real estate is illiquid and requires active management. Private equity? But private equity possesses high fees and long lockup periods. Commodities? But commodities don't generate cash flow. And increasingly, they examined Bitcoin, not as a speculative trade, but as a portfolio diversifier with low correlation to traditional assets. The data supported this. From 2013 to 2023, Bitcoin's correlation to the S&P 500 was near zero. Sometimes positive, sometimes negative, but always low. That means when stocks went up or down, Bitcoin frequently shifted independently. That's precisely what you desire from a portfolio diversifier. But institutional investors couldn't purchase Bitcoin directly. Regulatory constraints prevented most pension funds and endowments from holding crypto on their balance sheets. Custody concerns made boards of directors nervous. Operational complexity meant hiring specialized staff. The barriers were excessively elevated. They needed a regulated vehicle, an ETF, something they could purchase through their existing brokerage accounts with familiar custody and settlement. And once BlackRock provided that vehicle, once they eliminated the friction, the floodgates opened. In the first week of January 2026, IBIT perceived $888.6 million in net inflows. 1 week. $888 million. That's larger than most hedge fund launches. That's institutional currency coming in after New Year portfolio rebalancing. Fund managers adjusting allocations for 2026, and they allocated heavily to Bitcoin exposure through BlackRock. At the identical time, traditional banking deposits were declining. According to Federal Reserve data, commercial bank deposits collapsed by $212 billion in the fourth quarter of 2025. $212 billion. Where did that currency go? Some went to money market funds chasing higher yields. Some went to treasury bills directly. And an increasing amount went to crypto, not merely Bitcoin, stablecoins. And that's where the genuine threat to banking commences. Most people don't comprehend how banking functions at a fundamental level. They reason banks are safe deposit boxes. You position currency in, the bank holds it, you withdraw when needed. That's not remotely how it functions. Banks operate on fractional reserve lending. When you deposit $1,000, the bank is legally required to maintain only a fraction in reserve. Under current Federal Reserve regulations, banks must maintain reserve ratios based on their deposit size. But practically speaking, most major banks maintain around 10%. So when you deposit $1,000, the bank maintains $100 in reserve. The other $900 obtains lent out immediately to someone purchasing a house, to a business expanding operations, to someone financing a car, to a corporation constructing a factory. The bank earns interest on those loans, typically 4 to 8% on mortgages, 6 to 12% on business loans, 10 to 20% on credit cards. That's how they make currency. The spread between what they compensate depositors and what they charge borrowers, the system functions because not everyone withdraws their deposits simultaneously. On any given day, maybe 2 to 5% of depositors desire cash. The bank maintains enough reserves to cover normal withdrawal patterns. The other 95 to 98% remains deployed in loans generating interest income. But what occurs if that assumption fractures? What occurs if 10 or 20% of depositors desire their currency simultaneously? We perceived this in March 2023 with Silicon Valley Bank. SVB held approximately $200 billion in deposits, most of it from technology companies, startups, and venture capital firms. Those deposits were invested in long-term treasury bonds and mortgage-backed securities purchased when interest rates were near zero. Then, the Federal Reserve elevated interest rates aggressively from 0 to 5% in 18 months. Bond values crashed. A bond compensating 2% when market rates are 5% is worth much less than face value. SVB was sitting on massive unrealized losses, over $15 billion in paper losses on bonds they reasoned were safe. When depositors obtained nervous and initiated withdrawing currency, SVB had to liquidate bonds to raise cash. They had to liquidate at huge losses, realizing paper losses into actual losses. The losses destroyed the bank's capital base. Within 48 hours, Silicon Valley Bank went from solvent and operating to bankrupt and seized by regulators. $142 billion in withdrawal requests in a single day. The bank couldn't encounter them. It failed. The 16th largest bank in America collapsed in 2 days. That was one bank. Now imagine that dynamic executing across the entire banking system. Not because of a crisis, not because of panic, but because of yield competition, because customers recognized they could earn dramatically higher returns elsewhere. Depositors don't all shift simultaneously, but over months, the flow is steady and relentless. 3% of deposits in month 1, 5% in month 2, 7% in month 3, 10% in month 6. The numbers compound. The exodus accelerates. Banks initiate losing the cheapest source of funding they possess, customer deposits. They have to substitute that funding with more expensive wholesale borrowing from other banks or the Federal Reserve. Their net interest margins compress, the spread between what they earn on loans and what they compensate for funding contracts. Profitability collapses, stock prices decline, credit ratings obtained downgraded, borrowing expenses increase further. A doom loop. And here's the killer detail that most people overlook. The loans banks made don't disappear when deposits leave. If a bank lent $900 billion secured by customer deposits, and those deposits leave, the bank still possesses $900 billion in loans on the books. Those loans mature over years or decades. A 30-year mortgage doesn't mature for 3 decades, but the deposits funding that mortgage can leave in minutes, a few clicks on a phone. The only way to substitute deposits quickly is to borrow from other banks, through the federal funds market or from the Federal Reserve discount window. But that borrowing is expensive, much more expensive than deposits. And if multiple banks are competing for the identical wholesale funding simultaneously because they're all losing deposits to stablecoins, rates spike dramatically. This is a liquidity crisis, not a solvency crisis. The banks aren't insolvent. They possess assets, favorable assets, performing loans, treasury bonds, investment-grade corporate bonds. But those assets are illiquid. They can't be liquidated quickly without accepting massive losses. And if the bank can't fund itself in the short term, it doesn't matter that the long-term assets are valuable. The bank fails before the assets mature. We've perceived this movie before. 2008, Lehman Brothers, Bear Stearns, Washington Mutual, Wachovia. Banks with hundreds of billions in assets that collapsed in days or weeks because they couldn't fund themselves when confidence evaporated and wholesale funding markets froze. The distinction between 2008 and what's coming is the trigger. In 2008, the crisis was triggered by poor assets. Subprime mortgages defaulting, mortgage-backed securities becoming worthless, asset quality deterioration. This time, the assets are fine. United States government treasury bills, prime residential mortgages with borrowers who possess excellent credit, investment-grade corporate bonds from blue-chip companies. The asset quality isn't the problem. The problem is deposit flight driven by yield competition. And the trigger isn't crisis or panic, it's innovation, superior products, higher yields, more convenience. Stablecoins are simply superior than bank deposits for many use cases, objectively superior. And once that becomes widely comprehended, once the infrastructure makes them accessible to mainstream users, the shift accelerates exponentially. Banks comprehend this completely. That's why they're combating regulatory approval of yield-bearing stablecoins. That's why banking industry lobby groups are pushing Congress to decelerate crypto adoption. That's why Brian Moynihan is publicly warning about $6 trillion in potential outflows. He's not fear-mongering. He's stating mathematical reality based on yield differentials, but the momentum is already excessively robust. BlackRock's $70 billion Bitcoin ETF proved institutional demand exists. Circle's upcoming March initial public offering will prove stable coin demand exists at scale. And once both are legitimized, once mainstream financial institutions are presenting these products through familiar channels, the deposit flight commences in earnest, not as crisis, but as rational consumer selection. Now let's discuss what BlackRock is actually constructing. Because the Bitcoin ETF isn't the endgame. It's phase one of a multi-phase strategy to dominate digital asset infrastructure. Larry Fink, BlackRock's CEO and founder, has been remarkably public about his views on crypto and blockchain technology since 2023. He called Bitcoin digital gold in multiple interviews. He stated blockchain technology would fundamentally transform financial markets over the next decade. He predicted tokenization of real-world assets would be the next major wave of innovation in finance. These weren't offhand comments. These were strategic signals about where BlackRock was heading. Tokenization means accepting real-world assets, like stocks, bonds, real estate, commodities, and representing ownership through digital tokens on a blockchain. Instead of holding a physical stock certificate or an entry in a centralized database, you hold a digital token that represents the identical ownership rights, but with dramatically improved functionality. Why does tokenization matter? 3 reasons: speed, cost, and accessibility. Speed. Traditional security settlement requires 2 business days. You liquidate a stock on Monday, the transaction settles on Wednesday, the currency hits your account Wednesday afternoon. With tokenized assets, settlement is instant, seconds. You liquidate, you obtain compensated, done. No awaiting, no settlement risk, no counterparty exposure during the settlement window. Cost: traditional securities possess elevated transaction expenses. Brokers charge commissions, clearinghouses accept fees, custodians charge storage fees, transfer agents process ownership transformations. Every intermediary adds expense. Tokenized assets eliminate most intermediaries. Peer-to-peer transfers on a blockchain, direct ownership. Fees decline from dollars per transaction to pennies or less. Accessibility: traditional securities possess restricted access based on prosperity and geography. Many investments require accredited investor status, net worth over $1 million, excluding primary residence, or annual income over $200,000. Minimum investments of $100,000 or more for private equity, hedge funds, real estate partnerships. Tokenized assets can be fractionalized, possess 1/10 of a commercial real estate property, possess 1 share of a private equity fund, possess 0.01 Bitcoin. Democratized access to previously exclusive investments. BlackRock has been constructing this tokenization infrastructure quietly but systematically. In March 2024, they launched the BlackRock USD Institutional Digital Liquidity Fund, ticker symbol BWDL. It's a tokenized money market fund constructed on the Ethereum blockchain. Institutional investors purchase tokens representing shares in the fund. The tokens are programmable, instantly transferable globally 24/7, and can be utilized as collateral in decentralized finance applications. The fund invests in cash, treasury bills, and repurchase agreements. It yields approximately 5% annually, and it settles instantly. As of January 2026, BWDL holds over $700 million in assets. Small by BlackRock's $10 trillion standard, but it's operational, functional, battle-tested, proving the model functions at institutional scale. Now connect all the dots. BlackRock operates the largest Bitcoin ETF at $70 billion. They possess tokenized money market funds operating on Ethereum blockchain. They possess relationships with every major institutional investor in the world through their existing fund enterprise. They possess more assets under management than any competitor, and according to multiple industry sources, they're applying for federal stablecoin licenses under the Genius Act. In December 2025, reports surfaced that BlackRock filed preliminary applications with the Office of the Comptroller of the Currency to operate a federally chartered stablecoin. BlackRock hasn't confirmed publicly, but multiple sources familiar with the application progression state it's genuine and progressing. Imagine a BlackRock-issued stablecoin launching in late 2026 or early 2027, fully backed by United States Treasury bills held at regulated custodians, yielding 4.5% distributed to holders, available through every broker, every wealth manager, every financial advisor that already distributes BlackRock funds, which is basically everyone. Institutions trust BlackRock more than they trust Circle or Tether or any crypto-native company. If BlackRock presents a stablecoin with institutional-grade custody, regulatory compliance, transparent auditing, and competitive yield, adoption will be massive and rapid. Pension funds can hold it. Endowments can hold it. Corporate treasuries can hold it, all with board approval and fiduciary comfort. That's the master plan. 1. Bitcoin ETF proves crypto demand and generates $70 billion in assets. 2. Tokenized funds prove blockchain infrastructure functions. 3. Stablecoin provides the on-ramp for trillions of dollars to enter the digital asset ecosystem. And once dollars are in the ecosystem earning yield and operating on blockchain rails, they don't flow back to traditional banks. They remain digital, shifting instantly, operating globally, outside the traditional banking system entirely. This is why BlackRock's $70 billion Bitcoin ETF matters so profoundly. Not because $70 billion is transformative by itself, but because it's the proof of concept that unlocks everything else. It proved institutional demand existed. It proved regulators would approve. It proved custody solutions functioned. It proved the market possessed appetite. And now the infrastructure is being constructed systematically to capture the $6 trillion that Brian Moynihan perceives leaving traditional banks. BlackRock isn't attempting to construct a crypto company. They're constructing the next generation of financial infrastructure. And they possess the scale, trust, and distribution to actually execute it where others have failed. Let me demonstrate you precisely what occurred in January 2026, month by month, week by week. Because this month is when the tipping point became undeniable, when the trajectory became clear to anyone paying attention. Week 1, January 1st through 7th, BlackRock's Bitcoin ETF recorded $888.6 million in net inflows for the week. Not gross inflows, net inflows after redemptions. $888 million in a single week. That's institutional currency flooding in after New Year rebalancing and portfolio reviews. Fund managers making allocation determinations for the year ahead, and they allocated heavily to Bitcoin exposure through the largest, most trusted name in asset management. For context, the average equity mutual fund perceives inflows of $10 to $50 million per week. IBIT perceived $8 to $88 million. The scale is different. The conviction is different. This is institutional adoption at a pace nobody predicted. Week 2, January 8th through 14th. On January 10th, the 2-year anniversary of Bitcoin ETF approval, financial media ran retrospectives, articles analyzing the impact, interviews with fund managers who allocated, achievement narratives from early adopters. CNBC, Bloomberg, Wall Street Journal, all covering the milestone. This wave of positive press drove another surge of interest. IBIT perceived $412 million in net inflows for the week. More significantly, competitor ETFs perceived outflows. Currency wasn't flowing into Bitcoin ETFs generally. Currency was concentrating into BlackRock specifically. Investors desire the largest, most liquid, most trusted option. Network effects and winner-take-most dynamics executing in present time. Week 3, January 13th through 19th. On January 15th, Brian Moynihan provided his now famous speech at a closed-door banking conference in Florida. He warned attendees that $6 trillion in deposits could migrate to stablecoins over the next 36 months. He stated, banks must adapt or confront existential pressure. The speech was supposed to be private. Someone leaked it. Within hours, it was all over financial media. Bank of America stock collapsed 3.2% in 2 trading days. JP Morgan collapsed 2.8%. Wells Fargo, 2.4%. Regional banks collapsed even more difficult. The market initiated pricing in the stablecoin threat as genuine and material. Not someday, now. Week 4, January 20th through 26th. This is where we are currently. Multiple developments compressed into a single week. On January 22nd, BlackRock shifted $430 million worth of Bitcoin and Ethereum from cold storage wallets to Coinbase Prime. The transaction was visible on public blockchain explorers because all blockchain transactions are transparent and traceable. Within minutes, crypto Twitter exploded with speculation. Was BlackRock liquidating? Were they exiting positions? Was this a bearish signal? The reality is mundane and operational. When ETF investors redeem shares of IBIT, BlackRock has to deliver them cash. To obtain cash, they liquidate Bitcoin. To liquidate Bitcoin, they transfer it from secure offline cold storage to Coinbase Exchange. These are routine redemption flows, not panic liquidating, not strategic positioning, just operational mechanics of running an ETF. Possess 1/10 of a commercial real estate property. Possess 1 share of a private equity fund. Possess 0.01 Bitcoin. Democratized access to previously exclusive investments. BlackRock has been constructing this tokenization infrastructure quietly but systematically. In March 2024, they launched the BlackRock USD Institutional Digital Liquidity Fund, ticker symbol BUDL. It's a tokenized money market fund constructed on the Ethereum blockchain. Institutional investors purchase tokens representing shares in the fund. The tokens are programmable, instantly transferable globally 24/7, and can be utilized as collateral in decentralized finance applications. The fund invests in cash, treasury bills, and repurchase agreements. It yields approximately 5% annually, and it settles instantly. As of January 2026, BUDL holds over $700 million in assets. Small by BlackRock's $10 trillion standard, but it's operational, functional, battle-tested, proving the model functions at institutional scale. Now connect all the dots. BlackRock operates the largest Bitcoin ETF at $70 billion. They possess tokenized money market funds operating on Ethereum blockchain. They possess relationships with every major institutional investor in the world through their existing fund enterprise. They possess more assets under management than any competitor, and according to multiple industry sources, they're applying for federal stablecoin licenses under the Genius Act. In December 2025, reports surfaced that BlackRock filed preliminary applications with the Office of the Comptroller of the Currency to operate a federally chartered stablecoin. BlackRock hasn't confirmed publicly, but multiple sources familiar with the application progression state it's genuine and progressing. Imagine a BlackRock-issued stablecoin launching in late 2026 or early 2027, fully backed by United States Treasury bills held at regulated custodians, yielding 4.5% distributed to holders, available through every broker, every wealth manager, every financial advisor that already distributes BlackRock funds, which is basically everyone. Institutions trust BlackRock more than they trust Circle or Tether or any crypto-native company. If BlackRock presents a stablecoin with institutional-grade custody, regulatory compliance, transparent auditing, and competitive yield, adoption will be massive and rapid. Pension funds can hold it. Endowments can hold it. Corporate treasuries can hold it, all with board approval and fiduciary comfort. That's the master plan. 1. Bitcoin ETF proves crypto demand and generates $70 billion in assets. 2. Tokenized funds prove blockchain infrastructure functions. 3. Stablecoin provides the on-ramp for trillions of dollars to enter the digital asset ecosystem. And once dollars are in the ecosystem earning yield and operating on blockchain rails, they don't flow back to traditional banks. They remain digital, shifting instantly, operating globally, outside the traditional banking system entirely. This is why BlackRock's $70 billion Bitcoin ETF matters so profoundly. Not because $70 billion is transformative by itself, but because it's the proof of concept that unlocks everything else. It proved institutional demand existed, it proved regulators would approve, it proved custody solutions functioned, it proved the market possessed appetite, and now the infrastructure is being constructed systematically to capture the $6 trillion that Brian Moynihan perceives leaving traditional banks. BlackRock isn't attempting to construct a crypto company. They're constructing the next generation of financial infrastructure. And they possess the scale, trust, and distribution to actually execute it where others have failed. Let me demonstrate you precisely what occurred in January 2026, month by month, week by week. Because this month is when the tipping point became undeniable, when the trajectory became clear to anyone paying attention. Week 1, January 1st through 7th, BlackRock's Bitcoin ETF recorded $888.6 million in net inflows for the week. Not gross inflows, net inflows after redemptions. $888 million in a single week. That's institutional currency flooding in after New Year rebalancing and portfolio reviews. Fund managers making allocation determinations for the year ahead, and they allocated heavily to Bitcoin exposure through the largest, most trusted name in asset management. For context, the average equity mutual fund perceives inflows of $10 to $50 million per week. IBIT perceived $888 million. The scale is different. The conviction is different. This is institutional adoption at a pace nobody predicted. Week 2, January 8th through 14th. On January 10th, the 2-year anniversary of Bitcoin ETF approval, financial media ran retrospectives, articles analyzing the impact, interviews with fund managers who allocated, achievement narratives from early adopters. CNBC, Bloomberg, Wall Street Journal, all covering the milestone. This wave of positive press drove another surge of interest. IBIT perceived $412 million in net inflows for the week. More significantly, competitor ETFs perceived outflows. Currency wasn't flowing into Bitcoin ETFs generally. Currency was concentrating into BlackRock specifically. Investors desire the largest, most liquid, most trusted option. Network effects and winner-take-most dynamics executing in present time. Week 3, January 13th through 19th. On January 15th, Brian Moynihan provided his now famous speech at a closed-door banking conference in Florida. He warned attendees that $6 trillion in deposits could migrate to stablecoins over the next 36 months. He stated, banks must adapt or confront existential pressure. The speech was supposed to be private. Someone leaked it. Within hours, it was all over financial media. Bank of America stock collapsed 3.2% in 2 trading days. JP Morgan collapsed 2.8%. Wells Fargo, 2.4%. Regional banks collapsed even more difficult. The market initiated pricing in the stablecoin threat as genuine and material. Not someday, now. Week 4, January 20th through 26th. This is where we are currently. Multiple developments compressed into a single week. On January 22nd, BlackRock shifted $430 million worth of Bitcoin and Ethereum from cold storage wallets to Coinbase Prime. The transaction was visible on public blockchain explorers because all blockchain transactions are transparent and traceable. Within minutes, crypto Twitter exploded with speculation. Was BlackRock liquidating? Were they exiting positions? Was this a bearish signal? The reality is mundane and operational. When ETF investors redeem shares of IBIT, BlackRock has to deliver them cash. To obtain cash, they liquidate Bitcoin. To liquidate Bitcoin, they transfer it from secure offline cold storage to Coinbase Exchange. These are routine redemption flows, not panic liquidating, not strategic positioning, just operational mechanics of running an ETF. But the fact that $430 million shifted in a single day demonstrates the scale of institutional activity. This isn't retail traders shifting thousands. This is institutions shifting hundreds of millions daily as routine operations. The infrastructure is handling it. The liquidity is there. This is mature market conduct. On January 23rd, Circle formally announced their IPO roadshow would commence February 10th. The company is targeting a valuation between $12 and $15 billion. For context, that would make Circle more valuable than 85% of regional banks in America. A 6-year-old stablecoin company worth more than century-old institutions with branches, employees, legacy infrastructure. The symbolism is powerful. Traditional banking is literally being outvalued by digital alternatives. Markets are forward examining. They perceive where things are going, and they're betting on stable coins over banks. On January 24th, Fidelity announced their yield-bearing stablecoin would launch March 3rd, 2026. Initial distribution through Fidelity brokerage accounts only. 47 million Fidelity retail customers will possess access. Instant, seamless, right in their existing accounts. No need to open crypto exchange accounts. No complicated wallet setups. Just an option in their cash management menu. Hold dollars at 0% or hold stablecoins at 5%. The selection will be evident. On January 25th, Ripple received final regulatory approval for their federal stablecoin charter. That makes them the 5th approved issuer under the Genius Act framework. 5 federally regulated stablecoin providers launching operations in Q1 2026. All with the capability to compensate competitive yields. All with institutional-grade compliance. All with mainstream distribution through traditional financial channels. This is the inflection point. This is when stablecoins transition from crypto-native tools to mainstream financial products, from niche to normal, from speculative to standard. And once that transition completes, the $6 trillion deposit shift accelerates from possibility to inevitability. Let me walk you through what occurs over the next 12 months. Not speculation, but strategic projection based on current trajectories and historical adoption curves for financial technology. February through March 2026. Circle IPO occurs in early March. Market reception is robust. The stock price is above the IPO price on day one. Closes the first week up 20 to 30%. Financial media covers it extensively. CNBC brings on the CEO for multiple interviews. The narrative shifts from crypto being fringe and speculative to crypto being legitimate, with publicly traded companies, audited financials, regulated operations. Fidelity launches their yield-bearing stablecoin on March 3rd as scheduled. Initial uptake is modest but meaningful. $2 billion in the first week, $5 billion in the first month. Conservative initiation, but momentum constructs as word spreads among Fidelity's customer base. People initiate calculating the distinction, 0% versus 5% on cash balances. The mathematics is undeniable. April through June 2026. Other major financial institutions follow Fidelity's lead. Charles Schwab announces stablecoin integration in April. Vanguard, traditionally conservative, announces they're evaluating stablecoin money market alternatives in May. Merrill Lynch, part of Bank of America, ironically, launches stablecoin access for wealth management clients in June. All major brokerages presenting stablecoin accounts, not marketed as crypto products, marketed as enhanced cash management. Higher yield alternatives to traditional sweep accounts that compensate nothing. The positioning is critical. This isn't about blockchain or decentralization or disrupting finance. It's about obtaining superior returns on cash. Simple, evident, compelling. Corporate treasury departments initiate allocating, not entire treasury reserves, but test allocations. If a corporation possesses $1 billion in cash on the balance sheet, they shift $50 to $100 million to yield-bearing stablecoins. Earn an extra $4 million per year in interest income. No credit risk, no duration risk. Instant liquidity. The chief financial officers present it to boards as prudent treasury optimization. Boards approve. Word spreads in CFO networks. More companies follow. By end of Q2, total stablecoin supply hits $250 billion from $170 billion in January. $80 billion in new supply in 6 months. And that $80 billion came from somewhere. It came from bank deposits. Commercial banks report deposit declines in Q2 earnings calls. 2 to 3% quarter over quarter. Not crisis level, but noticeable. Concerning trend establishing, banks respond predictably. They elevate deposit rates. Instead of compensating 0.1% on savings accounts, they initiate compensating 1%, then 1.5%, then 2%. This compresses net interest margins. If a bank compensates 2% on deposits and earns 5% on loans, the spread is 3%. If they have to compensate 3% on deposits to compete with stablecoins, the spread declines to 2%. Profitability collapses 33%. Stock prices decline. Credit ratings confront pressure. Some banks respond differently. They partner with crypto companies instead of competing. JP Morgan announces a partnership with Circle to present USDC custody and distribution through JP Morgan accounts. Bank of New York Mellon launches stablecoin custody services for institutional clients. These banks position themselves as infrastructure enablers, picks and shovels providers. If you can't defeat the gold rush, liquidate shovels to gold miners. July through September 2026. The acceleration continues. Stablecoin supply hits $350 billion by September. The growth curve is exponential. Regulatory clarity, plus institutional adoption, plus retail awareness, plus higher yields, all factors converging. The perfect circumstances for rapid mainstream adoption. Bank deposit declines accelerate to 5% quarter over quarter. Now it's visible in headline numbers. Now financial analysts are composing reports. Now rating agencies are issuing warnings. Now it's becoming a mainstream narrative covered by general business press, not merely crypto media. Federal Reserve economists publish research papers analyzing the trend. Treasury Department holds hearings with bank CEOs and stablecoin issuers. Congress debates whether additional legislation is needed. But the momentum is excessively robust to legislate away. You can't uninvent technology. You can't compel people to accept lower yields when higher yields are available without additional risk. The market determines, and the market has determined. October through December 2026, year-end numbers come into focus. By December 31st, stablecoin supply reaches $420 billion, up from $170 billion on January 1st. $250 billion in growth in 1 year. Where did it come from? Bank deposits. For the full year 2026, commercial bank deposits declined by approximately $400 billion. Not all of that went to stablecoins. Some went to direct treasury purchases, some went to money market funds. But stablecoins captured the majority. They're simply the superior product. Higher yield than banks, more liquid than direct treasury purchases, more accessible than money market funds, superior in every dimension. $400 billion in year one. That's 7% of Brian Moynihan's $6 trillion estimate. Slower than his worst case, but the trajectory is established. The infrastructure is constructed. The adoption curve is accelerating. Year 2 will perceive larger outflows. Year 3, even larger, not because of crisis, but because of rational economic selection and compound growth dynamics. By end of 2027, cumulative outflows could reach $1 trillion by end of 2028, $2 trillion by 2030, potentially $3 to $4 trillion. Brian Moynihan's $6 trillion over 3 years might actually be conservative. The reality could be faster and larger than even the pessimistic banking industry estimates. So what does all of this mean for your actual existence, your currency, your job, your financial future? Because this isn't abstract theory. This affects you directly right now. First, if you possess currency sitting in a traditional bank account earning near zero interest, you're losing significant purchasing power to inflation. With inflation running at 3 to 4% annually, your $100,000 becomes $96,000 in genuine purchasing power after 1 year. Over 5 years, you lose $18,000 in genuine worth by holding cash in zero yield accounts. That's not a small number. That's genuine prosperity erosion. Once yield-bearing stablecoins become widely available through mainstream brokerages like Fidelity and Schwab, which will occur in Q1 2026 according to announced timelines, shifting a portion of your cash holdings makes mathematical sense. Not all of your currency, not your emergency fund that you might need tomorrow. But savings beyond immediate liquidity needs. Currency earning nothing in checking accounts. Cash sitting idle in brokerage sweep accounts. The risk profile is nearly identical to bank deposits. Stablecoins issued under federal charters are backed by treasury bills. Treasury bills are backed by the full faith and credit of the United States government. That's the identical backing that protects your bank deposits through FDIC insurance, which is also backed by the U.S. government. The risk is equivalent. The yield is 40 to 50 times higher. The selection is evident once you comprehend the mechanics. Second, if you labor in traditional banking, comprehend the structural shift that's occurring. Banks will need fewer physical branches as customers shift to digital-first financial services, fewer traditional bank teller roles, fewer loan officers as automated underwriting improves. This doesn't mean banking jobs disappear entirely. It means they evolve. Digital asset custody, blockchain infrastructure, tokenized securities operations, stablecoin distribution, crypto compliance. These are growth areas. Abilities in these domains will be increasingly valuable. Third, if you're an investor evaluating where to allocate capital, the companies constructing infrastructure for this transition will capture enormous worth generation. BlackRock, Coinbase, Circle, Fidelity. These are the picks and shovels companies of the digital asset gold rush. They don't accept Bitcoin price risk. They collect fees on transactions, custody, distribution. Steady, predictable, high-margin revenue streams as adoption scales. Fourth, if you're a business owner or corporate treasurer with significant cash holdings, corporate treasury management is being revolutionized right now in present time. Companies that adopt stablecoin treasury strategies early will possess meaningful competitive advantages, lower capital expenses, higher yields on cash reserves, instant settlement with global suppliers, automated treasury operations through programmable currency. These efficiency gains compound. Early adopters succeed. Fifth, if you're young and early in your prosperity constructing journey, the financial system you'll interact with in 10 to 20 years will be fundamentally different from the system your parents utilized. Learning about digital assets, blockchain technology, decentralized finance, smart contracts, tokenization, these aren't optional curiosities. They're essential financial literacy for the coming decades, like learning to utilize the internet in 1995. Not everyone comprehended it then. Everyone utilizes it now. Digital assets are following the identical adoption curve. Here's specifically what you should execute. Start small, open an account with a brokerage, presenting crypto exposure if you don't already possess one. Allocate 1 to 5% of your investment portfolio to Bitcoin through ETFs like BlackRock's IBIT. Not because Bitcoin will definitely elevate, but because portfolio theory suggests holding uncorrelated assets improves risk-adjusted returns over time. When yield-bearing stablecoins become available through your brokerage in Q1 2026, test them. Shift a small amount, $1,000, $5,000. Comprehend how they function. Perceive the yield accumulate. Verify you can shift currency in and out easily. Construct confidence in the infrastructure before committing larger amounts. Don't overallocate to any single innovation. Don't bet your entire net worth on crypto. This isn't about speculation or obtaining wealthy quick. This is about adapting to structural transformation in the financial system, the identical way you adapted from cash to debit cards, from paper checks to online banking, from physical stock certificates to electronic brokerage accounts. Evolution, not revolution. Adaptation, not disruption. Stay informed about regulatory developments. This space shifts faster than traditional finance. Regulations transform, new products launch, companies merge or fail. What's genuine today might be different in 6 months. Follow primary sources. Read actual SEC filings, not merely headlines. Comprehend the underlying mechanics, not merely the marketing claims. And most significantly, ignore the extreme voices on both sides. Crypto possesses evangelists who claim it's the solution to every problem and will substitute all traditional finance within 5 years. That's incorrect. Crypto also possesses skeptics who claim it's entirely worthless and will collapse to zero. That's also incorrect. The truth, as always, is in the middle. It's technology. Some applications will succeed massively. Some will fail completely. Your task is to comprehend which is which through careful analysis, not emotional reactions. Let me bring this full circle and connect all the pieces we've covered. On January 15th, 2026, Brian Moynihan warned that $6 trillion in deposits could leave the United States banking system over the next 3 years. On January 22nd, 2026, BlackRock's Bitcoin ETF held $70 billion in assets, precisely 2 years after launch. These aren't separate, unrelated narratives. They're deeply connected parts of the identical transformation. BlackRock's achievement with the Bitcoin ETF proved that institutional demand for crypto exposure is genuine, massive, and expanding. That proof of concept opened the regulatory and institutional doors for everything that follows. Stablecoins, tokenized assets, blockchain infrastructure, yield-bearing digital dollars. Once that infrastructure is constructed and operational, once yield-bearing stablecoins are available through every major brokerage with familiar interfaces and regulatory protections, the $6 trillion deposit exodus that Moynihan warned about shifts from theoretical possibility to mathematical inevitability. Not because banks are poor or failing, but because innovation provided objectively superior alternatives. Higher yields, lower fees, instant settlement, programmable currency, 24/7 global access. Superior products succeed. Markets determine. Customers select based on worth. This is the most substantial transformation in finance since the internet enabled online banking in the 1990s, possibly larger. Because online banking transformed the interface, the customer experience, the convenience. Blockchain transforms the actual infrastructure, the rails, the settlement layer, the foundation. The banks that resist this transformation will slowly contract into irrelevance. The banks that adapt and position themselves as infrastructure providers will survive and potentially thrive. The companies constructing the new infrastructure, the BlackRock's and Fidelity's and Coinbase's and Circle's, they will capture enormous worth as trillions of dollars migrate to digital rails. And the individuals who comprehend this shift early, who position themselves appropriately, who construct abilities in the emerging infrastructure, they will possess significant advantages in the financial system of 2035 compared to those who disregard it. BlackRock's $70 billion Bitcoin ETF didn't directly trigger a banking panic, but it proved the concept that made everything else possible. It legitimized institutional crypto adoption. It demonstrated that trillions in institutional capital desired digital asset exposure if provided the correct vehicles. And that legitimization enabled the stablecoin revolution, the tokenization wave, the $6 trillion deposit migration. It's all connected, all part of the identical transformation. And it initiated with one ETF 2 years ago that most people dismissed as a niche product for speculators. If this analysis has been valuable, subscribe to this channel immediately. Hit the notification bell because the next 90 days will be critical. Circle's March IPO, Fidelity's March stablecoin launch, BlackRock's stablecoin charter approval. Multiple catalysts converging in Q1 2026. The $70 billion proof of concept is complete and validated. The $6 trillion migration is commencing. And Wall Street's most substantial structural shift since 2008 is occurring right now in present time. The question isn't whether this occurs. The question is whether you comprehend it early enough to position accordingly. Thanks for observing.